So this is just general educational material. It's really a general presentation about retirement planning. Can I just get a show of hands? Is everybody retired here, or are some people about to retire? Retired. Everyone's retired. And is everybody already claiming pension benefits, Social Security? Already claiming benefits? Okay. Not Social Security? Okay. Does anybody have a spouse maybe that's still working? Yes. Okay. So some of this presentation will be maybe a little bit more relevant for the spouse as well. You know, retirement, as you probably know already, is a time of a lot of change and a lot of decisions around health and housing and long-term care and activities and hobbies and friends and how to spend assets and what's going on in the stock market and politics. There's a lot going on here, and we want you to be very well educated and aware of some of the different risks and opportunities that you will face in retirement. And the organization, the educational organization that sanctions the Retirement Income Certified Professional designation that I have, has identified 18 risks in retirement, which is kind of a staggeringly large number when you really think about it. That's a lot of risks that people may or may not be thinking about. And I want to go through some of those, some of the more, generally applicable ones, and really have people start to think about that. Longevity risk is a key. We just don't know how long we're going to live. Retirement income planning would be very easy if we knew when we were going to die. We would just spend the money to that point, we'd be done. But you'll see that longevity is an issue, and people are getting healthier, and they're staying active, and they're living longer, and there's some planning to be done around that. And then inflation risk. Sometimes we'll see people will try to go very safe in their investments and buy a lot of long-term government bonds, and maybe that's a good idea for some people, but if they are still going to live for a very long time, and inflation were to come back, it's relatively low right now, but if it were to come back, what would that do to purchasing power over time? So that's a clear risk. And then something that people don't really think about is what the American colleges call excessive withdrawal risk, and that's just spending assets too quickly. Maybe early in retirement, there's something we call the retirement income smile, and that means people usually start spending a lot early in retirement. They're taking trips, they're feeling good about things, they're buying a new car they always wanted. And then maybe in the middle time of retirement, spending goes down a little bit, and then towards the end of retirement, medical costs often start to kick up, and that spending goes up. So we want to make sure that there's enough money to get through to the end, and we don't spend too quickly in the beginning. Obviously, market risk with stock markets bouncing around, that can have an impact on account values. If you guys have pensions, you're a little bit protected from that, and that's something to be very thankful for, because that money keeps coming and is not susceptible to fluctuations in the stock market. But we want to be aware about that for assets that you have outside of a pension. Long-term care risk, forced retirement risk. If you have a working spouse and you're counting on them to continue working, well, what happens if suddenly they're not able to work for one of a number of reasons? So we want to be aware of that. And then there are issues that people don't think about so much, like public policy risk. That would be the risk of the government maybe deciding they're going to increase tax rates or change Social Security benefit, how that works. We don't know what that's going to be in the future, so we need to be cognizant of the possibility of things changing and not always being the way they are right now. Usually I'll do just a general Q&A about testing people's knowledge about how many people understand how their Social Security benefits may or may not be taxed in the future. I'll find people don't necessarily understand that they might have to pay for Medicare premiums or Medicare premium surcharges, or that they were married for 10 years to somebody and got divorced. They could still claim Social Security benefits based on their ex-spouse's earnings record. So, but I think in the interest of time and the fact that you guys are already retired, we'll just charge forward. And if anybody has any questions along the way, feel free to shout them out. If I have time and they're not too individual, I'll field them as we go along. So longevity risk, this really is a key one. And what people often get wrong about this is they kind of underestimate how long they may live. And so what this chart shows is that if you were 65 in the year 1990, and you were a woman, then the average life expectancy was 81 years of age and 80 for men. But if you were 65 in the year 2018, now if you're female, your life expectancy jumped to 85.6 years. That's a very big jump. And it's projected that by 2090, if you're a woman and you're 65 in the year 2090, then you can expect that your average life expectancy will be almost 90 years old. So that's telling us that over time, through better lifestyle, nutrition, healthcare, we are generally living longer. And so assets have to last longer, and these safety nets that we have to provide for ourselves have to last longer as well. Now, a key way that we think in retirement income planning is I want to have clients think about what are their really essential spending needs that I have outlined in the green here. And then what are the things that we want to spend on that are discretionary or optional spending needs? And those would be things like buying new TVs and taking trips and giving money to grandkids or children and helping them buy with their house. I would classify that as something you might want to do, but it's not a basic living expense. And to the extent that we can make sure that all of those essential spending needs are covered from guaranteed sources of income, like a pension, or like Social Security payments, or maybe a single premium immediate annuity, to the extent that we can cover those with sources of income that are never going to run out, that really provides a huge amount of retirement security. Because like I said, if you end up living to be 92 or 97 or 101 or 103, those guaranteed sources of income are still going to keep carrying you forward. So we want to understand spending really, really well, and we want to understand where the money is going to come from in a predictable, sustainable way so that you have a happy retirement. Make sense? So helping to solve the longevity and some of these other risks, I encourage people to try to get a good personalized life expectancy estimate. And there's a free website called livingto100.com. It's a little bit of work because it kind of asks a lot of questions. So it's not just, it doesn't just spit out a number in 2 seconds, but it's worth spending 15 or 20 minutes and going through. Do you have a history of diabetes in the family? Do you have a parent who lived for a long age? All of these grinding, do you smoke? How active are you? And that's going to give you a much better idea of what might be a more realistic life expectancy for you versus me versus somebody else. And so then that starts to frame, well, now how long might my assets have to last? Do I need to be a little bit more cautious on my spending, or can I spend a little bit more quickly? And this is going to be a little bit less relevant to you guys if you've retired already, but if you have the spouse that's still working, having them work a little bit longer to improve their Social Security earnings record and to increase their full retirement age benefit, that can be another very key step for people to take to help increase that percentage of your income that's coming from a guaranteed source that also has an inflation protection factor built into it. Now, key, of course, is unless somebody is in very poor health, delaying claiming Social Security is generally a very good idea for most people because, again, it's replacing a higher percentage of your pre-retirement income with a guaranteed source and a cost of living adjustment. And I just always like people to really drive home this point that the decision to stop working and the decision to claim Social Security benefits or the decision to stop working and start retirement benefits, pension benefits, are two separate decisions. And it constantly amazes me that people tend to kind of lump those two together. I stopped working, so I have to start claiming Social Security. That's not at all true. And so we really want to have a long think about that. Other decisions for people to kind of think about for guaranteed income in retirement is, should I take a life annuity payment option from an employer retirement plan, or should I just take lump sum distributions out of that plan? If I get a death benefit from a life insurance policy, everybody basically just takes the lump sum payment from the insurance company. Very few people evaluate other settlement options, which can include income for life. Again, that's not necessarily a bad choice, but it's something that people want to be thinking about. And then sometimes what we'll do is I'll study for a client, these are my basic expenses, this is the amount that my pension will provide and Social Security will provide, then maybe there's a gap up to the top of my essential expenses. Should we consider perhaps taking a portion of retirement assets and filling in that gap to, again, provide life income or joint life income for a couple? And then finally, reverse mortgages, you know, they're sort of have a bad rap, bad reputation. A lot of people think of them as bad. A lot of people think of kind of a lot of these financial products as bad. It's really much more about finding the right tool for the right circumstance in the right situation, and is that appropriate for that client? But we'll talk a little bit about reverse mortgages, which are also called HECMs, home equity conversion mortgages, and we'll see if that becomes an option for some people at some time. Again, I should just say, I'm not here to sell anybody any products. I don't do reverse mortgages, anything like that. It's really just more about education. Now, excess withdrawal risk is another problem that I see. People don't have an intuitive sense of how much money they should be spending. They've been used to working and saving. And that's why pension's great, because that check just keeps coming, and you know it's going to keep coming, we hope, and you know you can spend that money. But if you're drawing down assets out of a retirement account or out of your taxable account, your investment account, how much can I spend out of that? And that's a kind of a complicated topic. Retirement income planning has been described by one leading luminary in this field as trying to hit a moving target in the wind, because we don't know when we're going to die. We don't know what the interest rate environment's going to be, what the stock market's going to do, there's so much that's unknown, health consequences, and the timing of these factors is unknown. So we want to be cautious about how quickly we spend assets, but at the same time, we might not want to spend so cautiously that we don't get to enjoy life, right? So, and people make this mistake in their minds. They think that, okay, maybe my investments have a lot of stocks in them, and I can expect that over long periods of time, they will continue to return 8% to me. But then that does not mean they can spend 8% of their portfolio every year. That would be much too aggressive of a number for most people, and it would lead to a high likelihood of that money running out. So, because the 8% return is really over a 10-year, 15-year, 20-year time period. It's over long periods of time, and it never just shows up in somebody's account as 8% this year, 8% next year, 8% the year after that. No, it's up 15%, it's down 3%, it's up 0.5%. It comes in these seemingly random sequence of events. So just to give a sense, there's something called the safe withdrawal rate, and that is a study that a financial planner did, and he said over a 30-year period of time, how much could I spend on the first day of retirement out of my assets to have a very, very high likelihood that 30 years later I would still have at least $1. And that was 4% was the number that and so that's kind of considered a conservative benchmark. So if you've got $100,000 in a retirement account, the 4% rule gives you a sense of how much you can spend out of that. And also in a low interest rate environment, which is where we are right now, that might even be a little bit too aggressive if you're young, healthy, and you expect to live a long time. If you come from a family where everybody lives to be 120, I would be going really cautious on that spending and that 4% number. But on the other hand, if you're a little bit older, or you are willing to dial back your spending if your investments don't perform as well, then you might be able to do more like a 5 or 6%. But if you're spending 10% of your account every year, I can almost guarantee you at some point in the not too distant future, you're running too hot and you're spending those assets too quickly, and that money's going to run out. So just keep that in the back of your mind. And then lastly, I have this little example. And this is not so much for you guys because you have a pension, which is that guaranteed source of income that keeps coming. But to a lot of my audiences, if you were to retire at the age of 65 with a retirement account that had $200,000 in it, in a 401k account or an IRA account, could you live on $25,000 a year? And the reason why I use those numbers is $200,000 is approximately the average 65-year-old American's retirement assets. Not you guys with a pension necessarily, but that's kind of the average. And $17,532 is the average Social Security benefit. So there are a lot of people out there in America who that's kind of an average, and maybe for some of them that's better than they have. And $25,000 a year is not a lot of money, and not in LA it's not, to live on for the rest of your life. So now, this is going to be a little bit less relevant to you, given that you're retired, but they've done research, and 43% of people actually ended up retiring earlier than they planned to retire. And that's a very big number. I think the people generally think I'll retire at 65, and really a high percentage of them end up retiring at 63. And that couple of years may not seem like a big deal, but it really does make a dramatic impact in how sustainable and secure somebody's retirement is. Because it's another couple of years of actually spending resources, not saving and compounding resources. It also tends to be a couple years that are the highest earning years, usually, that could otherwise be factored into somebody's Social Security earnings benefit calculation, and also into the pension amount. So, and the other thing to point out about this is almost half of those people retired earlier than planned because of health, disabilities, or caregiving responsibilities. So if you do have a spouse who's continuing to work, I just would be cautious. We cannot necessarily we cannot count on them stopping work when they plan to stop work. We may have to prepare for them stopping work earlier than they want to stop work. And that can have an effect on how sustainable things are. Another thing is the pension's great because somebody else is taking care of that and they're just sending you the check. That's awesome. But in the money that you have yourself that you control or self-direct, sequence of returns risk is something that's very important to understand. And that is, again, that the money that you have, no matter how you have your money invested, the returns in that investment account come in kind of a random order. And if you happen to be unlucky enough to retire into or need to spend money when some of those bad returns come in, I mean, the average might be 8% over time or 6%, depending on how you have your money invested. But if you happen to have bad luck in bad timing and need to sell some of those assets to turn them into cash, to spend them for things that you want to spend, that can have a very detrimental effect on how long that pot of money can last in retirement. So how would we think about that? Well, can we set up other pools of money or other sources of money that we can draw on if things are not going so well in the investment accounts or the retirement accounts that you control? So that, do we have uncorrelated sources of liquidity that we could draw on? So let's say my stock portfolio drops by 10% this year, and I want to retire, or I need to spend money, pay for college, or whatever it is. Do I have some other assets that I can sell that are not being affected, and I can let that wait, write it out, let that recover, and then maybe tap that account? But again, you guys are pretty lucky because you probably have a fairly good percentage of your basic expenses being covered by your pension, hopefully. Asset allocation. This is a really important thing because it's a key driver. How we divide up your pot of money into stocks, bonds, cash, gold, real estate investment trusts, all of these different kind of investment choices. That choice drives something like 92% of the overall outcomes, the results. It's not which stock you buy, it's just what percentage of stocks do I have, what percentage of bonds do I have, what percentage of cash do I have. So that's the first thing to point out. What's my asset allocation? Do I know what that is? Do I know how much risk I'm taking? Am I comfortable with that? In our business, we talk about risk appetite or risk tolerance and risk capacity. So the risk appetite is, do I feel nervous if my accounts lose a lot of money in a short amount of time or a year or two? Does that freak me out? Am I stressed out? Am I constantly worrying? Can I not sleep? Or am I basically able to distance myself emotionally from that? And I may not like it. In fact, I know I don't like it, but I can live with it until it recovers. That's risk appetite. But risk capacity is how much capacity of risk can you withstand If you have a low risk capacity, you might be forced to sell something and it might be at a bad time, so we want to avoid that. And what I sometimes see is people may not feel as prepared for retirement, or they want to spend more money in retirement, and so then they start taking risks that they really probably shouldn't take. And they want to try to outperform their situation and the fact that they maybe didn't save as much in the past. And that can lead them to kind of moving towards the right here and taking much more risk. And again, then I have to ask, is that wise? Would we be better off maybe taking a different choice, trying to save money elsewhere or make different choices? Because the last thing we want to do is see somebody take way more risk than they really have the ability to withstand, and then have an unlucky occurrence happen, and then be forced to sell or panic and sell. Public policy risk, this is something I spend a ton of time with my clients talking about. And that is, this shocks most people, but the highest federal marginal tax rate ever in America was a whopping, eye-popping, mind-blowing 94% in 1944. After World War II, now look, a lot of people didn't pay that, but 94%, this is a big number. It's a really big number. And then in the 50s, 60s, and 70s, that rate bounced around somewhat, but it was never less than 70%. It was the highest tax bracket. So now today, we're in a much lower federal tax rate regime. 37% is the highest tax bracket. So you may say, well, I'm not in the highest tax bracket. That's fine. But I just illustrate, I bring this up to illustrate that these things can change, and right now we happen to be in an environment where the tax brackets are very, very wide, meaning you have to have a lot more taxable income before you jump into the next bracket and start paying some additional at a higher rate. And the rates are low, so I just encourage people to think about, to the extent possible, should I be paying some more of the tax today or pushing more of the tax to later? Now, you may be a little bit constrained in that at this point, receiving pension benefits already, but I want clients to be thinking, should I be thinking about partial Roth conversions of my tax-deferred accounts over a period of time where I can give the IRS their share, because I know the IRS is my not so silent partner in some of my retirement accounts. I want to selectively choose when's a good time for me to give them their share at the lowest possible price. So, and another way to think about bringing taxes forward or pushing taxes later is, should I make a Roth IRA contribution or a tax-deductible IRA contribution? Should I do a partial Roth conversion, as I said, or should I not? Just keep in mind that you have some flexibility to work with your tax preparer to say, would it make sense for me over a period of time to make a series of little partial Roth tax conversions, pay the tax on that now, and then kind of have purchased some tax insurance, if you will, on that pot of money, so that now I know that that's going to be tax-free and the growth of that's going to be tax-free. So I won't spend too much time on this, but
I thought IRAs and stuff was mostly based on your physical earnings, not on your investments. Is that not the case?
That's absolutely the case. To make an IRA, and there's been a significant change now with what's recently passed called the Secure Act, but as of now, you need to have some earned income, and earned income means working at a job, or running a small business. I mean, you could you could crochet tea cozies, and sell them. That's earned income. So there are ways to have earned income, but you cannot take your pension benefits and just based on that, or your Social Security benefits, or your investment returns, and just based on that money, you cannot make a contribution to an IRA or a Roth IRA. So yes, it has to be earned income, but keep in mind, you can earn income even as a retiree. You could have some sort of hobby or sell something on eBay, or, I'm not sure. Yeah. Yes.
I do want to follow up on things, because I thought her question was a little different. So with a 403B right now, which maybe many of us would have from in Goya.
Yep.
So if we over the next 5 years wanted to take $15,000 of that down, and have them move it directly into a Roth IRA IRA that we might have opened
Yep.
some time ago.
Yep.
Right? That is legal. That would save us, that issue of after 2026 or whatever your date was right there. And moving that, working with your tax person, of course, you basically have to pay your income tax, and you don't want to use that money, so you're supposed to have money on the side, I think is what they say, right? But that's a somewhat of a smart move, knowing that those brackets are probably going to pay.
I'm glad you brought that up. So to make a contribution to an IRA or a Roth IRA, that requires earned income, as I've said. But to do a conversion from a 403B, a 401k, a traditional IRA, a simple IRA, a SEP IRA, to do a conversion, anybody can do that at any time. You don't have to have any earned income or anything. That's just a question of, do I want to convert some of my pre-tax money into after-tax money and pay more taxes today at the tax rate that I'm in right now? Now, a couple of things to be a little bit cautious about with that. A lot of people don't necessarily understand that Medicare has what's called a 2-year look back. And so at the age of 65, people go on a Medicare, and hopefully they do it on time and they do it right, so they don't have any lifelong penalties and premiums and stuff. But at 65, they're on Medicare. And choices, and so Medicare will look back 2 years to the age of 63, what was your taxable income at that point? And then that might affect you might affect your premium surcharges 2 years later. So just be cautious that in general, especially if you're in a lower tax bracket, I personally love the idea of people really having a hard look at doing a series of partial Roth conversions. Because what I'm doing is I'm starting to fill up for clients, I'm filling the tax buckets. We never want to waste these low tax buckets, 10%, 12%, 22%, maybe 24%. If you're on a 12% tax bracket and you can do a partial Roth conversion to get up to, but not too far up that income tax scale, and I can pay those extra taxes that I'll owe from that choice that I chose to make out of extra money that I have on the side, not out of the account, but out of my taxable savings. I think that's a fantastic idea because I like to see clients build up buckets of money, 3 buckets of money, some taxable money, that's a bank account, that's a brokerage account with investments, some tax-deferred money, that's your 403B, 401k, IRA, and some tax-free money. Usually that's the Roth 401k or Roth IRA. Because then I've got flexibility to kind of pull for clients the target amount of retirement income that they want to spend. I can pull that out of different buckets up to different thresholds and lower their overall tax burden over a long period of time, over their retirement. So those were great questions. Thank you.
What's the benefit or what's the purpose of paying taxes on withdrawal from some money you have saved up as opposed to the money you're withdrawing?
Well, we want to have money that gets into a Roth IRA, let's say, continue to compound, or tax-deferred money continue to compound. So I don't want you, so what could happen is you might end up you might convert a bunch of money, some money out of your tax-deferred account into your Roth IRA, for example. That's going to raise your taxable income in this year. And then if you don't have money sitting in a taxable account to pay that extra tax burden, that might require you to take more money out of your tax-deferred account to pay those taxes, which is then starting to work against what we're trying to do, which is we're trying to keep the average tax burden lower over retirement. Does that make sense? So strategies to kind of give the IRS their cut when it suits you, not be driven, not let the tail wag the dog. I talked about filling the tax brackets. Ticking time bomb, that sounds a little dramatic maybe. But I see clients who have these tax-deferred accounts that are growing and growing and growing, and they have a pension coming, and they've got Social Security coming, and there are all these layers of taxable income that are just sort of backing up and stacking up. And then at some point, they may get in the situation where required minimum distributions come from their IRA accounts or their tax-deferred accounts, and then the Social Security is getting more taxes piled on top, the pension's adding on top of that, and then they're creeping up into higher and higher tax consequences. So that's what I mean about that. Just looking forward, everybody kind of shows up with their tax preparer on April the 10th or something, and they try to rush through their taxes. I want to encourage you to look forward to, well, how do I think things are going to be 3 years, 5 years, 10 years out from here, and just get ahead of that a little bit. Social Security, there's a lot of mistakes I see people make around Social Security. One is a lot of people will rush to get their hands on Social Security as soon as possible. They tend to be, in my experience, people who are terrified that Social Security is not going to be there and they'll get nothing, so they want to get whatever they can get as soon as they can get it. I don't really think that's a legitimate concern. Maybe for an 18-year-old, but if you're in your 50s, 60s, 70s, you're getting close to the time when you're going to draw Social Security. It's going to be there in some format. Sooner or later, Congress has to make some adjustments, probably raise the amount of income on which Social Security taxes are charged, probably bump up a little bit the age for full retirement. It's not, I don't think, going to go away completely. So that tends to be a fear-driven decision. But other people sometimes don't have any other assets. And if you don't have any other assets and you just have to have money, then you're going to grab Social Security as quickly as you can. But as I've said, that tends to be like a very short-sighted decision, and it can really harm the surviving spouse as well. So we want to be careful about that. But Social Security, God bless them, they send out these statements, or you can download them now, and they've got this big number on the top. Your benefit's going to be $2,700 a month or something, and it's all big. Well, that's based on assumptions, and some of those assumptions can be totally not applicable to you. So you've got to be really, really careful that you're not counting on something which you're not planning on getting. So if you have a spouse who's still working and they're looking at their Social Security record, we want to make sure that they understand that at the bottom of one of those pages, that number is based on that person working and continuing to earn the last year's reported Social Security earnings amount till their full retirement age. So if your working spouse is not planning on doing that, then that's going to overstate and overestimate the amount of your Social Security benefit. Secondly, I like, on the right-hand side, this is a little small, but you see like this person's earnings record, and some years they had like high earnings, Social Security taxed earnings. Some years they had really zero or low earnings records. And that's just a key conversation. If that person works a few years longer, they're going to kick out probably some of those low earning years of Social Security, and that's going to help increase the benefit calculation for Social Security, and it's going to get them to that place where they're going to have a higher percentage of their retirement income from a guaranteed source with a cost of living adjustment, and potentially help their surviving spouse as well. So I always want people to look carefully at this and then claim at the right age. If somebody is in really poor health, yeah, they might grab their Social Security as early as possible. But generally, do you want to bet on dying young, or do you want to plan around living a long time? I don't want to bet on dying young. So I'm going to claim later, and I'm going to try to stay healthy. You see me pacing this and getting my steps in. So this is an important decision for people, and it's the same with pension, for that matter. Pensions have a calculation, how the benefits are calculated. If I work a little bit another year, my benefit goes up, and that's more security in retirement. So similar kind of concept. We talked about this a little bit. Sometimes people don't know about the government pension offset or the windfall elimination provision that can also reduce the amount of Social Security benefit for certain people. And it's not like Social Security says this applies to you or me. So again, it can be a source of misinformation. So the Secure Act, this passed recently, and it's kind of a big deal. They changed requirement minimum distributions out of tax-deferred accounts from the age of 70 and a half to the age of 72 for most people. If you had already reached the age of 70 and a half in 2019, then you still have to keep taking your required minimum distributions. But the general rule is now our MD is 72, not 70 and a half. So that potentially allows a little bit more time for tax-deferred accounts or Roth IRA accounts, to keep compounding before you have to take out of the tax-deferred accounts. There's now also no age limit on making traditional IRA contributions if you have the earned income. Previously, you could only make Roth IRA contributions at any age. Now, if you have the earned income, you can make traditional IRA or Roth IRA contributions at any age. So that's a change. The elimination of the qualified stretch. There used to be this concept, maybe I would leave my son or my grandkid my Roth IRA because it could keep compounding and compounding and compounding. Because the old rule used to be if somebody inherited the IRA or a Roth IRA and was not the spouse, a non-spouse beneficiary, they could stretch those distributions out of those accounts over that beneficiary's life expectancy. And that's changed, and that's a big deal. So now there are a few categories. A surviving spouse who inherits your IRA or your Roth IRA, a minor children of the account holder up to their age of majority, any person who's not more than 10 years younger than the IRA participant, and anyone who is chronically ill or disabled. Apart from that, if anybody else inherits the IRA or the Roth IRA, those accounts have to be fully drained within 10 years. So there's some planning around that. And that's maybe also making a Roth IRA a little bit more advantageous now. The Roth IRA that somebody inherits who's not the surviving spouse or a minor or chronically ill, it still has to be drained within 10 years, but it's avoiding dramatic tax consequences. So what could happen here is you might have taken your 403B and converted it into an IRA, or you have an IRA, and you've left it to one of your children. And what a more probable scenario is that you pass away, and then now your adult, well, I'll just say I died, my adult child now inherits the IRA and probably is in an age when they're at their peak earning years. And now they have to drain that IRA within 10 years. They could delay it for 9 years, but the 10th year comes around, they have to take the entire amount. So again, that might now bump them up into a much higher tax bracket than they would otherwise be in. So now in that scenario, the government, the IRS, is getting more of that, and your beneficiary is getting less of that. So just something to be aware of.
If you had previously inherited, say, your parents' or your mother's IRA, would you be in a position now, if, say, you inherited it 4 or 5, 10 years ago, or whatever, would you be in a position now to have to drain it?
No, I think in that situation, you would have already been required to have required death distributions starting the year after, and you're going to keep carrying on with that. Yep. Yes, sir.
Does it apply, does the rule, the 10-year rule apply to Roth IRA also?
It does apply to Roth IRAs. So in a best case scenario, your beneficiary doesn't need the money, and they'll let it keep compounding for 10 more years. But then that 10th year comes, it's all got to come out. Now, the benefit is it all comes out tax-free and all the earnings come out tax-free. So it's not less tax efficient for the beneficiary. But unfortunately, then it's out of the Roth IRA and now it's sitting in a taxable account and the tax-free compounding is not going on. But, they could take that money and maybe use that to contribute more to their 401k savings or their Roth IRA. But charitable giving, some people, 5 minutes, I better hustle here. QCD, some people, want to give money to charity, which is great if they can afford to do it. I encourage, do we want to put on our own oxygen mask first before putting it on the charities. But if you want to give money to charity, a lot of people write a check to charity. It's usually not the most tax efficient way. If you are 70 and a half and you have an IRA, you can do what's called a QCD, a qualified charitable distribution, but you have to do it correctly. And that means your IRA custodian sends the money directly to a charity, and it has to be a 501c3 charity. You don't take the money out of the IRA, record it as taxable income, and then write a check to the charity. That's not as tax efficient. So you might say, well, I don't have an IRA. Well, if you want to give to charity and you have a 403B or a 401k, keep in mind that you could roll some of that money into your own IRA, and then you could do a QCD, but you have to be careful because there's complications around how to do that. And the benefit of that is QCDs don't require you to itemize on your taxes. So if you're writing a check to charity and you're not itemizing on your taxes, you're getting no tax deduction from that activity. As opposed to the QCD, goes out of your IRA directly to the charity. You don't have to itemize. It doesn't come into taxable income. That may make you more tax efficient as well in terms of keeping the taxability of your Social Security benefits down, your Medicare premium surcharges. So just keep that in mind and ask about that with your tax preparer.
Are there any limits on amounts for the CDs?
There are. It can only be up to $100,000 per year. And one more time?
How many years?
You just have to be 70 and a half. You have to have an IRA, and it can be up to $100,000.
Per year, but how many years?
Well, until your money runs out. But I guarantee you, charity's ears are burning right now. They want to know who this guy is. Okay, so just quickly, what if you feel like 3 minutes? Oh my goodness, I got to start talking quickly. What if you feel like I am not super confident in what I've got going on? I want to leave you with a couple of ideas. Monitor your spending. Most people I find can easily cut 5, 6, 7% of their spending out. It's kind of, and not really feel it even that much. I'll see people and I'm looking, Hulu, Amazon Prime, HBO Now, DirecTV. You can't possibly be watching all these things at the same time. Like, it's not for me to tell people how to spend their money, but if you want to achieve this goal, I just encourage you to relook at how you do it, okay? You might also want to think about if you just recently started claiming Social Security and you don't feel confident about your situation, was it within the last year? Could I suspend my Social Security benefits, give them back my money? I can do that within 1 year of claiming benefits, and then start getting delayed retirement credits. If it's been more than a year since I claimed Social Security, I can no longer suspend the benefits. I can no longer withdraw the benefits, but I can suspend them. So, okay, Social Security, I claimed 2 years ago. I'm not so sure that my financial situation is as good as I want it to be. Please stop sending me my Social Security benefits. And from that point on, I'm going to start accruing some additional delayed retirement credits. Then at the age of 50, they're going to send me a higher amount, which is going to keep carrying me through, maybe help improve my picture. Look at your investment costs. How much are you paying for investments? How much are you paying for the tax consequences of the choices that you're making? How much are you paying for a financial advisor? Do I have the right asset allocation? That's another key area to look at. Look at your deductibles on your home and auto and those kinds of things. Could I lower my premiums, and could I withstand paying a higher deductible? Do I have money in the bank? I see people with a $250 auto deductible, and I ask them, do you get into an accident all the time, every week? Because if you don't, and you've got some cash sitting in the bank that could cover a $1,000 deductible, then you could save the extra premiums. So that might help in the long run as well. And should you maybe go back to work a little bit or start a hobby? I don't like to make people go back to work if they hate working, but if you could earn a little bit of money and staying active and engaged, that could potentially help if you feel not so confident about your overall retirement picture. Check your estate planning, please, please, please. Everybody in this room has got some sort of estate planning done. It's done by the state of California, and it's probably not what you want. So I like to see clients check how they hold title to their real estate. I want to make sure that when one spouse passes away, the surviving spouse gets a step up in cost basis on 100% of the asset, not on 50% of the asset. So how you hold title, do you have a will? Do you have a irrevocable living trust? Is that appropriate for you? Have you moved things into the trust? I see clients who went to LegalZoom.com or something, and they just downloaded something, and they didn't really know what they were doing. And it's better, in my view, to have a competent estate planning attorney take a look at what you're doing and make sure that it is meeting your needs as well. So that's something else important to think about. Credit score, monitor your credit score, manage your debt. I think we heard a little bit about that. Be informed, proactive. You guys are already doing that. We didn't really talk about a HECM, but a lot of Americans, their home equity is kind of all or most of the wealth that they have. Should they think about tapping that? For some people, that is the right answer. But keep in mind, that is a loan. It's not free. There are appraisal costs. There are all sorts of costs associated with a HECM. reverse mortgage. We didn't really get to talk too much about that. Finally, you can find a certified financial planner at plannersearch.org. I would say about being a CFP, it's like getting a driver's license. It doesn't make you a good driver. So hopefully find somebody who's got some technical competence and will answer your questions, ask questions, not make you feel like you are bothering them, and stay informed and engaged. And with that, I will turn it back to Heather.